JP Morgan recently released a note saying that the ETF market is expected to double to $15 trillion in 5 years. While early ETFs introduced passive index tracking strategies to the masses, actively managed ETFs have grown in popularity in recent years. As we navigate a landscape of persistent inflation, rapid technological advancements, and a growing demand for sustainable solutions, investors face a unique challenge: how to seize growth opportunities while managing the risk associated with a dynamic market. In this video, I'll introduce the 7 best high-growth ETFs that are poised for success. I'll break down their unique advantages, explain how they can help manage risk, and why they deserve a place in your portfolio. And at the end, I'll reveal a high-growth ETF that could deliver up to 20% returns. So don't miss it. These ETFs have been carefully selected to help you build a diversified and solid portfolio, combining sustainable growth, innovation, and global opportunities. 7. iShares US Infrastructure ETF. The GRIP is one of the top funds available for investors who want to capitalize on the massive investment in U.S. infrastructure. With the federal government allocating over $1 trillion through the Infrastructure Investment and Jobs Act, the country is entering a modernization cycle that will directly impact companies in the sector. Roads, bridges, transportation systems, and energy grids are at the forefront of these initiatives, creating significant growth opportunities for the companies included in GRIP. Among its main components are Caterpillar, a global leader in heavy construction equipment manufacturing, and NextEra Energy, a pioneer in renewable energy. These companies highlight the fund's diverse approach, combining traditional infrastructure with innovations aimed at sustainability. In addition to its growth potential, GRIP is renowned for its resilience. During periods of economic volatility, sectors like infrastructure tend to remain stable due to government support and the essential nature of the services they provide. This makes GRIP an attractive option for investors seeking to balance growth and security in their portfolios. If you invest $10,000 at the current price of $45 per share, you could acquire approximately 222 shares. Assuming an average annual return of 7%, your investment could grow to around $14,025 in 5 years. Furthermore, with a 2% dividend yield, you would earn approximately $200 annually in dividends, creating a passive income stream that can be reinvested to accelerate your portfolio's growth. It is more than just an ETF. It's a bet on tangible projects shaping the future of the American economy. For investors interested in stability with long-term potential, this fund is a strategic and relevant choice. It's important to note that this video is not a recommendation for investment. I'm simply sharing my perspective on the market to provide you with insights. 6th, Schwab US Dividend Equity ETF with ticket CHD, one of the most popular ETFs for investors seeking a combination of stability, passive income, and consistent growth. This fund is designed to invest in mature American companies known for their solid history of dividend payments. With a carefully selected portfolio of assets, CHD provides exposure to giants like Johnson & Johnson, Coca-Cola, and PepsiCo, which not only offer reliable dividends but also have strong financial fundamentals. The main advantage of it is its ability to balance capital growth with regular dividend payments. The fund has a dividend yield of approximately 3.7%, meaning that for every $10,000 invested, you can expect to receive about $370 annually in dividends. Additionally, HD is incredibly cost-efficient, with an expense ratio of just 0.06%, one of the lowest in the ETF market. Historically, has shown strong performance. Over the past 5 years, it has delivered a compound annual growth rate of 11.6%, outperforming many other dividend-focused options in the market. An initial investment of $10,000 could have grown to over $16,300 during this period, while generating substantial passive income. For investors interested in reinvesting dividends, SCHD offers an attractive opportunity. By reinvesting the $370 annual dividends into new shares, you not only increase your exposure to the fund, but also accelerate portfolio growth over time. 5. Invesco S&P 500 GARP ETF with ticket SPGP. It is the ideal choice for investors looking to combine capital growth with investments based on reasonable valuations. The acronym GARP stands for Growth at a Reasonable Price, and this approach allows the ETF to select companies from the S&P 500 index with high growth potential that are still undervalued in terms of price. Among the main companies in SPGP's portfolio are names like Meta, formerly Facebook, Alphabet, Google's parent company, and Broadcom, all of which are leaders in technological innovation. These giants are known for their ability to reinvest profits and drive innovation in sectors such as artificial intelligence, cloud computing, and semiconductors, ensuring sustainable long-term growth. SPGP does not solely focus on technology. It also includes companies from other sectors such as healthcare, finance, and consumer goods, ensuring significant diversification. This makes it less volatile compared to ETFs exclusively focused on technology while still delivering attractive returns. Historically, SPGP has consistently outperformed the S&P 500 with an average annual return of 11%. With a yield of around 1%, it also adds a modest boost to your capital growth strategy. Fourth, Global X MSCI Argentina ETF, ARGT, a unique opportunity for investors interested in capturing the explosive growth potential of emerging markets, specifically Argentina. Despite its history of economic volatility, Argentina has shown signs of recovery and economic transformation, especially in sectors such as technology, consumer goods, and energy. I recently visited Argentina, and the country's economy has evolved significantly, especially when compared to 2023. This ETF provides a way to access this emerging market without the need to invest directly in individual stocks, significantly reducing risks. One of the main drivers of ARGT's recent performance has been the adoption of economic reforms and broader recovery in key sectors. In 2024, for instance, the ETF delivered an impressive return of 66%, becoming one of the best-performing global ETFs that year. Companies like Mercado Libre, a giant in e-commerce across Latin America, and YPF, one of the largest oil companies in the region, form the core of this fund, reflecting its exposure to rapidly growing sectors. With a conservative annual return of 12%, this ETF's primary focus is capital growth, capturing the development of a promising emerging market. Third, iShares U.S. Broker-Dealers and Securities Exchanges ETF with ticket IAI. Moving to the financial sector, we have a solid option for those who believe in the continuous growth of electronic trading and capital markets. The main components of IAI include names like Nasdaq, one of the largest stock exchanges in the world, and Charles Schwab, a leader in brokerage services. These companies have benefited from the increase in electronic trading volumes and the democratization of access to financial markets, trends that show little sign of slowing down. In recent years, IAI has delivered solid performance, with an average annual return of approximately 10%. Additionally, this ETF offers a 1.5% dividend yield, adding a modest source of passive income to your portfolio. Imagine investing $10,000 in IAI at the current price of $105 per share. This would allow you to acquire approximately 95 shares. In 5 years, with an average annual growth of 10%, the value of your investment could grow to around $16,105. Additionally, you would receive approximately $150 per year in dividends, a sum that could be reinvested to further increase your gains. 2. Technology Select Sector SPDR Fund XLK, essential for investors looking to capitalize on the robust and continuous growth of the technology sector. This ETF provides exposure to some of the largest and most innovative companies in the world, such as Apple, Microsoft, and Nvidia, all of which are leaders in their respective fields. These companies are driving advancements in artificial intelligence, cloud computing, semiconductors, and automation, technologies that are transforming global industries. With an impressive performance track record, XLK has delivered a compound annual growth rate, CAGR, of approximately 15% over the past 5 years, outperforming many other ETFs. This growth reflects the resilience of the technology sector, which continues to thrive even under challenging economic conditions due to its importance across nearly every global industry. XLK is ideal for investors who believe in the central role of technology in shaping the future economy. While it is more volatile than sectors like infrastructure or dividends, XLK offers significantly higher potential returns, making it an excellent choice for long-term investors seeking substantial growth in their portfolios. 1. ARCA Innovation ETF with ticket ARKK. Managed by the renowned Cathie Wood, this is a bold choice for investors seeking exposure to disruptive and emerging technologies. Focusing on companies leading innovation in sectors such as artificial intelligence, robotics, biotechnology, blockchain, and renewable energy, ARKK offers a concentrated portfolio of visionary investments with the potential to transform global markets. Among ARKK's top holdings are companies like Tesla, a leader in electric vehicles and clean energy, and Roku, a powerhouse in streaming and digital entertainment. These companies are selected based on the disruptive potential of their products and services rather than traditional financial metrics, which gives ARKK a higher risk profile but promises above-average returns. Although ARKK has faced significant volatility in recent years, the ETF has shown impressive growth during market upswings. In a recovery scenario, annual returns exceeding 20% are possible. However, this ETF is best suited for investors who are willing to accept significant short-term fluctuations in exchange for potentially substantial long-term gains. Want to know how to prepare for a possible recession in 2025? Click on the video on the screen. Subscribe if you enjoyed this video. Good investments.